Sunil Subramaniam joins us. Let's connect with him and let's say hello to him. Sunil, good morning. Thank you for joining us. Are you joining us from Chennai?
Yes.
I'm surprised. There is a match on Sunday. You should be standing outside the stadium. Lamba line hoga, bhai lag jao udhar.
अरे चेन्नई में मैच है ना.
हाँ, so you should be standing outside the stadium. It will be a long line, no? You should
नहीं
queue up right
टिकट है
now.
तो लाइन क्या लाइन की बात नहीं उठती है.
You got the tickets?
Yes.
Great. Enjoy the match. Enjoy the match. Okay. Markets. Bit of a yes and no here. Bond yields are going higher, FIs are selling. The logic is that if yields are going higher, FIs will sell more and that will weigh down Indian markets. Is there logic in assuming that?
No, some amount, but I would say that it's more about the trend in future yields rather than the absolute level of the yields. Okay. Why I say this is interest rates have been high in the US for quite some time. And from April onwards, you've seen while emerging market flows have been pressure precisely because of the yields, India had been receiving flows despite the higher yields. So it is the trend line that matters because for India, more than yields, it's the oil price trend that's more critical. So I think as far as FI is oriented towards India is concerned, the higher yields in the US have more or less been factored in. It's the oil price trend which affects India's fiscal as well as inflation and a whole host of EPSs of companies. That's far more of a concern. And that's why the rising oil prices probably, I would rate it at a higher risk factor in terms of flows as compared to yields.
Sunil, historically it is seen that when mid-cap level stocks reach the current levels based on 1 year forward P multiple, a very simple yardstick, the future returns, they get compromised. Are we reaching that stage where past returns may not be the indicator of future?
Not at all, Nikunj, because this 1 year forward PE as a measure, right? It's something that as allocators look at. So if there is somebody who's got a pot of money and says how much I put large, made how much in small, he looks at these valuations to decide his inter-say asset allocation. But a fund manager who's doing bottom of stock picking, first of all, when he's picking a stock, he's looking at a 3 to 5 year forward PE for that stock, discounting those cash flows to the present from a net PV, NPV perspective and see whether today's price makes sense. So in mid-caps, because of the cyclicality, the high operating and financial leverage, this is the first year of recovery that you're seeing, in a way. So in that context, right, those mid-cap companies which are going to build off the domestic economic growth, whether it be capex cycle or discretionary consumption, are going to post higher and higher EPS growth in the coming years. And when you then factor those in, many mid-cap stocks look reasonably valued today to buy from that perspective. So fund managers would continue to buy those even though 1 year forward PEs may look rich there. So to that extent, I think that in a cyclical story, go back to 2003 to 8, we are in a very, very similar kind of a phase. The capex cycle in India is yet to really kick off. It's only the government that's been holding up capex. Private sector capex is an announcement stage, but over the next 12, 18 months has to come into play and the mid-cap segments will benefit from a strong rise. And even a 10% rise in their top line will lead to 25-30% rises in their EPSs because high interest and high depreciation costs. So I would say that the quality of the stock is the concern. We all know that in the mid and small cap space, retail investors come in, operators come in, a lot of rumors make stocks go up. So those kind of stocks, we don't get support from a fundamental research-oriented mutual fund, insurance company, or a portfolio management service provider will continue to get buying support. And other thing, Nikunj, to note is that today a significant shift in the SIP flows in terms of small cap and mid caps has also happened. So because of which fund managers will continue to get installments of mid cap and small cap fund money from investors right through to keep buying good quality stocks. So I think what we are going to see is a clear separation between quality and momentum or hawa, as you may call it.
How has Sundaram Mutual Fund off late invested? When I say off late, last 3 to 6 months, what's been the change in positioning? How have you participated in the IPO market? How are you approaching new themes and sectors now?
So for us, I think one of the key things there is that where we have had a change in stance, and Nikunj, you'll be surprised to know this because I know you're tracking us. So we had actually gone underweight on cement a few months ago because more of valuation, not because of demand concerns, more because valuation.
Of course, I track it. Ramco Cements, how can I forget? Ramco, how can I forget? It was, I think you owned 5% of the equity, right?
At one point. But we went through a phase where we were underweight there, Nikunj, and we are back to being neutral to overweight on cement. So that's one big change in stance. The second stance, which is that we were heavily underweight in pharma, we moved that to neutral because we see a lot of selective stocks that we can buy there. The third is in terms of, for us in the new age IPOs, we are more into buying these IPOs a few months after listing because the IPOs tend to be a bit, price jacked up, if I may call it that way. So we wait for the things to settle. And a lot of the IPOs which came over the last 1 year, 2 years, we actually didn't participate so much, but we are now buying some of those stocks in an open market kind of a situation. So the digitalization and the formalization, the new age fintechs, I think those are the spaces where we feel that the Indian economy's growth is going to be well represented, right? That apart, I think industrials and capital goods continues to be strong overweight for us. And for all the thing around banking, we feel that banking still has enough juice to be a safety plus kind of a sector. So we continue to be overweight on the banking sector.
Sunil, so bank is more like a linear theme. You know, it's like a secular India bet. India will grow, economy will grow, banking sector will keep on providing capital. It held true 5 years ago, and I'm sure it will hold true for next 25 years also. But where are you spotting opportunities? Either there is deep value or those companies or businesses are at a cusp of either market share gain or earnings recovery. Like you mentioned, pharma, cement. Can you be slightly more specific about next 2 or 3 years where you're finding a combination of either value or growth or both?
So I think that because it's a relative feature, I think what's happened is the market has diverted attention towards cap goods and infra heavily over the last few months, and hence discretionary consumption has tended to suffer. So we believe that that's the real cyclical story, if you see, because A, they are rate sensitive because EMIs are involved in the purchase of most discretionary consumer items. But second is they are highly cyclical because it's mostly mid and small cap companies, which, like I said, borrow heavily, hence interest costs are very high, and their plant and investment costs are also very high. So they are highly leveraged. So we believe that the capital allocation from the markets has not gone towards discretionary consumption as much as it should have. And consequently that, especially the premiumization of consumption, which is a very strong, I think as per capita income grows, the premiumization, you're already seeing the beginnings of that very strongly in the automotives, in housing. You're seeing the high-end properties, high-end cars selling much, much faster. And we believe that that's a segment which is fully not tapped yet. And cyclically, you will see that the EPS growth of these companies will outpace the consensus forecast precisely because of the high leverage component. So I think on a 3 to 5 year basis, we believe that mid and small cap discretionary consumption is a very, very good where we feel still is value. Now, from a PE ratio, it wouldn't look like value because they're discounting the current earnings or 1 year forward earnings, and the price will look like, oh, you're paying so many times that. But like I said earlier, the third, fourth, and the fifth year when their earnings really shoot up, that we are today discounting, and there we see value in terms of the whole mid and small cap discretionary consumption play. So if you ask me, that's one place where I do see value from a slightly longer term perspective if you hold that in your head.
Sunil, what will happen to global sectors? China, metal is a bet on China, IT is a bet on US, manufacturing is a bet on Europe. What happens there?
So globally, we are not very positive on what's happening. I mean, the US GDP data and all seems to keep surprising us. But if you look at the credit cycle that's happening there, that, people are revolving credit like there's no tomorrow. There's jobs, there is a slowdown. So we believe that a slowdown is inevitable. Now, between the hard landing and soft landing, you could have probability factors in. But we don't think that there's a growth story in the world yet happening. We believe that the world is going to go through an extended period of a slowdown. Europe will be a little more suffering there, that fact. So any external oriented sectors tend to be underweight. This includes metals, this includes energy, and this includes even IT to that extent. So we believe that the growth story of the world is still at least a couple of years away in terms of the world booming back to growth. It's going to be an extended slowdown. There will be false alarms keep coming. So we would rather stay cautious on the sidelines. And China, the story behind China is that not only are they linked to the developed world's growth, but there is a distinct political shift of America, especially from buying from China. You see, Mexico and Canada are now getting a much larger share of imports from America. So there's clearly a political angle to the fact that they're buying less from China. adding to China's own structural problems like high wage costs, declining labor population, and all of that. So China, especially, we are not very bullish from an economy perspective, also from the transparency aspect. So overall, from a world perspective, right, I would say that for us, domestic India looks far more attractive than the world at this stage. To some extent, the flows are discounting that story, and that's there. But I still believe that our growth will continue to surprise market expectations, and hence, India is the place where the bet should be.
Sunil, one thing I'm just observing, and you've seen more cycles than me, is that these days the rate of change is very fast. Okay, boom in manufacturing, within next 3 months, manufacturing stocks are up 3-4 times. Boom in defense, within a year, defense stocks are up 3-4 times. Boom in railways, railway stocks are up 5-6 times in less than 2 years. It's happening so quickly, right?
Yes, absolutely. And that's the problem with the, I would say, hot button tendencies. One, two, three things I would point out here. One is the general hot button tendencies, right? Because there's so much liquidity and the desire and the demand to deliver return at every stage, every month, or every quarter, everything. So the need to keep rotating among people who deploy money. That's number one. The second aspect which leads to this is also the demography. I think the investment demography is now far younger, right? And they don't have the patience and they are too eager to act. So the youth, by and large, whether it's through mutual funds or through direct equities, I think the youth of the investing population is contributing to these reactions. And the third I would mention, and this is also especially from foreign also, is the tendency to shift to algo. So in algo, what happens is you fit in certain preset formulae, right? And when you put in those formulae and those triggers happen, the machines actually trigger a buy or a sell. So I think the significant promotion of algo trading, and attached to this is also a larger story, which is that the move to passives across the world means that fund management fees overall has come down, right? So in a bit to stay competitive, while extreme active is very difficult in the foreign markets, what's happening is the smart beta, as they call it, is adding a little bit of tickers, momentum-based or factor-based investing. Now, these are again, to some extent, computering. The computer throws up a formula saying, based on track record at this stage, you put in money. And then when you put in that money, that changes the ratios, right? Because no money has flowed in, the P ratios have gone up. And then the computers say, no, sell out and go to the next. So I think this is the part of the internet age, the part of the information age. We are all part of it in the information revolution. And I think we need to learn to address this and go forward. You can sit on the sidelines and keep criticizing these things. But if they're actually happening and making a difference to your life, I think best is to keep track, understand it, and make accordingly portfolio allocations at our end.
Covered a range of topics, and do send us your pictures when you're watching the match. Send us a selfie. We'll have to carry it.
Yeah, sure. Thanks.
Enjoy the match and thank you for joining us.